We're celebrating more than 2 million Canadians choosing Fidelity. And to say thank you, we're giving you a chance to win a branded Fidelity hoodie. Enter by visiting fidelity.ca/hoodie-contest. At Fidelity, performance is more than a number. It's progress, confidence, and momentum. So choose performance, choose advice, choose Fidelity. Now, here's today's show.
Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Equity markets are continuing, this is a global story, a victorious reach for higher and higher gains as optimism from the durability of earnings and demand for the AI build-out broadens, while new mega IPOs sit right there on the horizon. For the debt markets, a decidedly different tone is present. With Kevin Warsh now at the Fed's helm, can equity markets post sustained inclines with the overhang of a priced-in hike, or maybe even hikes, plural? As it turns out, there are many ways to look at the risks of upside and downside for the global equity story. And as we enter a week of oil prices calming down, the final leg of earnings for this quarter and the cresting of these gigantic IPOs, we are extremely privileged to have Fidelity's Director of Global Macro, Jurrien Timmer, joining us with his market insights. Warm welcome to you, Jurrien. Thanks for joining us.
Yes, greetings from a rainy Boston.
A rainy Boston. We've had something similar in sort of central Canada for the last little bit. And I'll just remind everyone that everyone joining you here today, this webcast features live French audio interpretation. Shall we begin with the discussion of what last week has meant and ultimately where it's sort of bringing us on the cusp of this week? But last week was just full speed ahead on the equity side of things.
Yeah, why don't we bring up the heat map just to get the conversation started. So, we're at the intersection of a lot of different cross currents, of course. We have, of course, the Strait of Hormuz, which remains largely closed. No, the first slide, sorry. And so, I challenge you to be able to read all this.
We got our spectacles out here. We got it, yeah.
Take my word for it. Green is generally good. Red is generally bad. But I track this kind of on a weekly basis to see how the little puzzle pieces are coming together or not. And what we're seeing is that despite the closure of the Strait of Hormuz, despite rising interest rates with the 10-year yield in the U.S., reaching almost 4.7% last year, we see the equity fundamentals continue to get better. So operating margins are making new highs almost every week. Earnings growth is very, very robust. The forward estimates growing at a 20% clip. Credit spreads making new lows. Investment grade corporate spreads are like 74 basis points. And so these are the fundamentals that really drive the bus over the long term. And actually, if we just, where's my chart? Slide 10. If we take just those pieces of the puzzle, earnings growth, margins, credit spreads, and the 10-year yield, and we plop them into a very rudimentary regression model, and I'm no quant, so I'll be the first to admit that, and we test this over the last, 60 years or so, you can see that generally speaking, those factors have a good way of explaining where the market is and where it might be going. So the top panel is the S&P 500. The bottom panel is the 5-year CAPE ratio, the 5-year PE ratio. And the first thing that jumps out is how vast the tech bubble was in 1999, 2000. The market really ignored all the fundamentals back then. And it's nice to see that today that is not happening. So that's a very good thing, given that we're often comparing today with the AI boom to 25 years ago with the internet boom. And it shows you that higher prices are warranted because margins are rising, earnings are growing, credit spreads are low, and the bond market, except for last week, has been relatively well behaved. And those are the things we need to keep our eye on as long-term investors. And we often get obsessed over price. Where's the Dow Jones trading? Where's the S&P? Where's the Nasdaq? But the price is really just a residual, right? It's earnings, and it's how much investors are willing to pay for each dollar of earnings, right? That's the valuation. And the price is at the intersect of the E and the V. And so we really need to solve for what are the earnings, how much should we be willing to pay for those earnings, and then you end up with price. And so that's kind of the message I try to drive home over the weekend with my report.
Well, and it's amazing. And you go into the discussion of, so we're just about at the end of the earnings. There's some important ones still to come through. We've taken a look at sort of the consumer story, and even the large tech players that when they have sensational earnings and the market still doesn't really reward them, actually punishes them a little bit, we can still see things overall tracking higher. It's still okay. Yep. And so yes. I guess there's a reward for the earnings sort of in that way.
Yeah, and what often happens is when a sector or a theme is overly loved, like the AI theme, of course, is, and a lot of people are in those stocks, you need to keep besting expectations on and on and on to keep that momentum going, and that's a really tall order. Like that, there's going to come a point where Nvidia or some other company is not going to be able to beat estimates, or no matter what they say, people want more, right? And so that's inevitable. Doesn't mean the stock is broken at all, or the theme is broken, but that generally happens when a trade gets crowded, and you have to argue that the AI boom probably is a little crowded here because it's very well known.
So with that, and taking into consideration what the bond market was doing last week, which did calm down sort of partway through the week, so arguably it's maybe that's not as sustainable. But you go in your report to take a look at what could be the hiccup and what it's essentially worth on the price side of things, should the bond market essentially become competition, because rates are so high and it's a pretty good return for a lot of investors.
No, exactly. So let's go to slide 6. Slide 6, and this is an important thing to kind of remember, is that again, earnings valuation is what drives the bus most of the time. And in this chart, I show the S&P 500 with a PE band. So the pink line is 20 times earnings, expected earnings. The yellow line is 22, and the orange line is 24 times earnings. And you can see that generally speaking, at least since 2020 or so, the S&P has traveled in that band. So that's kind of the band that represents earnings expectations at just about more or less reasonable valuations. Now sometimes you'll go above it, and then that might be a yellow flag that maybe investors are getting a little bit too ambitious, and sometimes the price level will just kind of fall below that band. And generally speaking, that's when either there's a massive shock, for instance, COVID in 2020, you see that there towards the left. But 2022, which was entirely a rate reset, we remember it well, of course, the PE just fell out of bed, even though the earnings were still pretty good. And so that's a way of showing that interest rates can kind of lurk sometimes in the background and maybe even come into the foreground. And if we ask ourselves why, we can go to slide 11. This is called the Fed model, and you and I were talking before.
Why is it called that? It's not a good model. Good isn't the right word, but you'll tell us.
So the Fed model was famous during the 80s. If you look at that middle part where the shading is red, you see 87 there, the 87 crash. That was a very famous example of the Fed model. And basically what the Fed model says, and Alan Greenspan, this used to be one of his favorite indicators, so he may have coined this indicator, or the market coined it for him because this was the thing he would talk about, is that when the risk-free rate, so the 10-year Treasury, is competitive with the yield on equities, so the earnings yield or the inverse of the PE, when those two yields are in sync, and you can see that in the top, right? I show the purple line is the S&P 500 PE, and the black line is the PE of bonds, so the inverse of the yield. You can see where when the shading is red, which means bonds and stocks are positively correlated, those two yields or those two PEs tracked very closely to each other. Then when stocks and bonds became negatively correlated, which is the blue shading, the model didn't work because interest rates were held down by central banks. And now stocks and bonds are positively correlated again. And you can see just on the right there how closely the two yields are trading together. So you and I have talked a lot about, 4.5%. That's, above 4.5, nothing good happens above 4.5. There's nothing magical about 4.5 versus some other level other than the bond yield is at 4.5 and the stock yield's at 4.5. They're both trading at a 22 PE. And when the bond side moves, it affects the equity side. And you can see that actually, let's go to slide 8 for a moment. You can see that as the yield, which is on the horizontal axis of bonds, goes up, the correlation between stocks and bonds goes up as well. So there's a very clear relationship between the correlation of stocks and bonds as yields go up. And that makes perfect sense because as yields go up, the risk-free asset becomes cheaper and the risky asset needs to compete with that. And so where does that take us now? If we go to slide 9, you can see another scatter plot. I love my scatter plots. The bond PE on the horizontal, the equity PE on the vertical. Right now, they're both trading at a 22 PE, so they're exactly in sync. And what we saw last week and the week before is as the bond yield starts to creep up above that 4.5, and we ended up Friday at 456, but we went as high as 469. It pushes the equity PE down, and that's what we saw last week. Is that you would have things that whether there was news out of Iran or not, if the bond yield was moving up a lot, which it did for a while, the stock market responds by going down because it has to compete. So if we went to a 5% bond yield, which is not a prediction, but it's very plausible, I think, that would knock the equity PE down to about a 19 PE from 22. It's not the end of the world. It's what, 15%, and again, that's only
15%. Okay, that's what it would cost.
Yeah, and again, that's only the V, right? We have to think about the E as well, which brings me to the most cosmic slide this week, which is slide 7,
this is super cool.
Which again shows the intersection of earnings and valuation. So I'll explain this chart. Horizontal is earnings growth. The vertical is the change in the PE ratio, the year-over-year change. The size of the dot is the annual return or the year-over-year return in the S&P. If the dots are empty, that means a negative return. And then you see this curved line. That is basically the intersect between the returns being positive and being negative. So if you think about it, if valuations are going up on the vertical and earnings are either going up or not going down a lot, the market tends to do very well. And vice versa, if earnings growth goes up a lot, but the PE is going down, which tends to happen at inflection points, the market doesn't do as well. And of course, the kiss of death is the lower left quadrant, which is when both earnings are going down and the PE goes down. That happens during super bear markets like financial crisis in '08, dot-com burst, the dot-com bust in 2001. We're now in the very sweet spot, which means that, which is because earnings are growing at double digits and so are valuations. So if the E plus the V equals the P, you can see that we're really in a very good spot right now. But again, compare that to periods where bond yields were on the move, despite otherwise good fundamentals. You can still have a negative return, and that brings me to back to slide 6 for a second.
Okay, yeah, I just want to ask one question in there. Carry on.
Yeah, I know. So in slide 6, you can see 2018 there towards the left. And earnings were booming because of the tax cuts from 2017. But we also had what we used to call Volmageddon in January of 2018. And then we had the period later that year when Powell tried to normalize rates a little bit too fast, and the markets fell out of bed by 20%. And that was entirely the product of interest rates. The market wasn't even expensive back then. But and so that's kind of the distinction I'm trying to make here. So earnings are very strong. margins are rising, credit spreads are low, all the fundamental stuff you want is there. The one fly in the ointment potentially is interest rates. And if the valuation goes down from 22 to 19 because rates go to 5, the PE would go down 15%, but the price may go down a lot less because the E on the other side is compensating. And so that's how I think about sort of this puzzle of all of these moving parts and how they affect the markets.
That's so fascinating. I mean, crudely put, taking a look at yields on shorter term is more to do with everything to do with inflation concerns about the war and so on. The longer term story, which is where you're seeing the yield story really literally pick up and go up, I mean, appears to be tied to whether the United States can pay its debt, which every country is kind of concerned about that because they spent a lot on COVID. It's not an isolated situation. But I guess to what extent is that being fixed right now? You can tell they're going at it a few different ways, but that is the concern for further out, is it not?
Yes, and if we go to slide 4, this is the 10-year yield. You can see there it's trying to peek its head out of this triangle, and that's a very big triangle. It's been around for several years. And you can see the dotted line is the SOFR curve, which is now pointing up. Market is pricing in a rate hike. That's just a snapshot in time, so that could be gone tomorrow, right? So it doesn't mean that the Fed's is or isn't going to do anything. And of course, Kevin Warsh is now the new Fed chair, and I think the markets generally are happy that he's an adult. He's not some crazy that does not deserve the job but will do the president's bidding. So at least we have an adult in the room. Scott Bessent is the other adult in the room. So we have two now, and they will work together, I'm sure, to try to manage the debt and to keep interest rates as under control as possible and play around with the balance sheet of, what's the Fed going to own? Will the Treasury use its TGA account, which has almost $1 trillion in it? So I think, I would not want to bet against Scott Bessent in terms of, looking at this chart and wanting to short bonds too much. I think that's, I think yields will go higher, but I think that's a dangerous game because, the Treasury can play around with all kinds of tools, right? It can stop issuing long bonds. It can use its TGA instead of issuing bonds. It can issue just treasuries, and then the Fed can buy them and roll them off. I mean, there's all kinds of games they can play. But for me, the most important chart is 19, which is coming back to the Strait of Hormuz. And we see here the Bloomberg Commodity Spot Index, which, of course, is driven by oil, by gold and copper and all kinds of other commodities. But, and then below it, I showed the 5-year TIPS break even. And, this is a chart that gives me some pause because if you look at the left-hand side of this chart, the BCOM spot index and TIPS break evens are basically identical, right? I mean, they all move exactly in the same way. And in 2022, when oil prices went up after the COVID inflation, again, the TIPS break evens followed suit. Then it all went back down and all good. And now the commodity index is at a new high and TIPS break evens are still sitting there, apparently whistling past the graveyard. And that to me, if that bottom chart starts to get unanchored and it follows the commodity charts, you could have a little bond tantrum on your hands in a pretty big way. And that brings me back to what we've been talking about for weeks, which is slide 16. And that is that, what is a portfolio, a diversified portfolio? What should that look like, right? I don't want to be short the 60, right? The equity side, we've already discussed how great the fundamentals are. Exactly, yeah. But the bond side, to me, when I look at that last chart and I look at the triangle that I showed earlier, and I look at this chart, which shows the moving correlations between stocks and bonds and other asset classes, you see those two those two black arrows on the top and on the right. That's the correlation between stocks and bonds and bonds and stocks, and they're about to
converge,
about to meet each other. It looks like, right? So their correlations are rising. So if there is sort of a tantrum in the bond market, a Fed model type thing, It is going to affect the stock market, but it's going to affect the bond market as well. And then we want to be in what we call the true diversifiers that are moving in the opposite direction, not only of stocks, but of stocks and bonds. And those are the dollar, commodities, managed futures, cash. And to me, that's Bitcoin and gold are sort of moving towards bonds here. They're kind of doing their own little song. I certainly would want to own them, but hard asset commodities I think are sort of stealing the show right now. But I would want to own all of them, and that would be the 20 of the 60-20-20. So I think it's important at a time like this when it seems like we have all the equity fundamentals down pat, and it couldn't be any better. We do have that other tail, the interest rate tail, that hopefully doesn't wake up, but it could, and we need to be ready for that.
What if it wakes up in countries outside of the United States and you have sort of a global story? We've talked about this quite a lot. Many countries around the world have finished their cutting cycle, and 2 months ago, before the Gulf War, were probably ready, if anything, to just hold for a long time or make their way back up, because that's just where they were in the cycle. What happens, or what is the opportunity? Where would you lean if you see globally interest rates going up, but maybe less so in the U.S.?
Yeah, and they are going up. This is not just a U.S. phenomenon.
I mean, Australia has been hiking for a while, so.
Yep. Australia, Japan, of course, is the leading bear steepener. Canada, UK, Germany, European yields. The only two that are not moving up are Swiss bonds, but the Swiss are in their own little world. And actually Chinese bonds. Chinese yields are very low because Chinese investors don't have a lot of places to put their money. And they have some deflation over there. So that actually is a truly uncorrelated bond market, but it's also China, and it has also all sort of other idiosyncrasies along with it. But it is a global bear market in bonds, and it will put pressure on central banks. And right now, the fact that it is global, I think, cancels out much of the currency effects, because normally you would look at that SOFR curve and you would argue, well, the dollar should be going up, but it really isn't going up very much at all. And so it is a global phenomenon, and that ultimately
that's
becomes
protective in a way, to the bond vigilantes on some level, picking on one particular place.
Yes, exactly, and that makes it less of a currency story, but more of a hard currency versus paper currency, and this is where gold and Bitcoin and other real assets come in. And this, I think, is one of the reasons why gold has been so strong for a number of years, even though it's taking a backseat right now.
Can we take a look at the chart you have on Bitcoin? Because it's again, I think you were mentioning it wasn't quite a winter, but it was a long autumn, or whatever you're going to call it. But it's been resurgent, hasn't it?
Yeah. Slide 15. Yeah, so I would call it a mild winter.
Okay, mild winter.
And the winter should be getting milder. So this is my 60-20-20 at the top. Not investment advice, but just my back of the envelope drawing of what a 60-20-20 would look like and how it would do. And then in the bottom are various momentum curves of a handful of the assets that, for me, are on the menu or should be on the menu. And we can see that the BCOM, the commodity index, is at the top. It's losing a little momentum, but it's very, very strong. And then you have, the Mag 7 obviously has a lot of momentum, emerging market stocks as well. The S&P is done just fine. And then you'll have Bitcoin there at the bottom. That was the mild winter when everything else was pretty good, and gold was very strong while Bitcoin was very weak. And clearly there was some rotation of assets there, kind of the fast money crowd jumping off the Bitcoin bandwagon to chase the gold bandwagon, and then they reversed, and now Bitcoin is ascended again. And Bitcoin, I think, is in the early stages of another bull market. And it follows a very repetitive cycle pattern, right, on a log scale. So it's an exponential pattern. but you can make sense of it in terms of each winter versus each summer, if you will. They follow a certain pattern. And so if this winter is ending and we're at, 77,000 right now, the bottom was at 60,000, I could see Bitcoin going to 300,000 if it follows the same patterns that it has in terms of those previous bull markets. So I definitely want to be in that, even if right now it's still trying to find its footing.
One of the arguments for looking at EM in sort of post-Iran war is that oil, falls off a cliff if things do come to an end. There's a lot of things that happen when one asset class makes a big move one way or the other, and it does look. WTI has been coming down for over the last several days. What are some of the post-Iran war ramifications of oil falling, and maybe just further afield from that? But how do you kind of get ready for that if that's what we should be doing?
So if we go to slide 2, I think if this thing really finally ends, even if the U.S. comes away with egg on its face because Iran might actually control the Strait of Hormuz, which it didn't before. But this thing has a positive resolution and oil goes back to $50, $60, $70 a barrel. I think the broadening trade could resume. So here I just show the S&P 500 cap weighted index in black, equal weighted in blue, and breadth in the pink. And you can see that this explosive rally coming off of that March 31st low. It's just vertical, but that's the Mag 7, right? Or the Mag 10, or whatever the AI leaders are. And finally, the S&P equal weight is following. It just made a new high finally, but it's lagged behind. And so what I think would happen is that, remember in the beginning of the year we were cheering the sort of the bullish broadening trade where the market broadened out without it coming at the expense of the Mag 7. That allowed the rising tide to lift all boats as opposed to being in a zero-sum type of situation. So my sense would be that we would have that rotation would resume because it was abruptly stalled out because of the Iran conflict. So, and that would translate then to other markets as well. If we look at earnings, EM earnings have been on fire because there's obviously an AI trade there as well. But IFA, non-US developed, really have been lackluster. And so I think that whole, everything would sort of start to equalize again, and you would go back to maybe a less robust but more broader type of bull market.
Has the world...
It would hopefully bring quiet back to the bond market, because really, if you think about what is moving what right now, right, it's oil prices are very negatively correlated to stocks and positively correlated, and stocks are positively correlated to bonds. So what happens is, it goes up, the bond market reacts because it affects inflation, and when the bond market reacts in a negative way, the stock market reacts in a negative way, and that is the loop we're in. And if oil were to break back below kind of the levels, back to the levels pre-war, you would break that loop, and then we can just follow the fundamentals and not worry about the bond market, attacking us from behind.
It removes that risk. I only have 30 seconds here left, but has the energy rotation in terms of where everyone in the world gets their oil from, has that, at least in the minds and hearts of countries and investors, has that rotation begun?
I think it has, but there's a limit, right? I mean, oil is something you got to move around, and that's not easy to do. But it's it's a good reminder that no matter how green we all try to be, and I think we're all trying to be green, there's no getting around to the fact that the world runs on oil, and this episode, which hopefully goes away soon, is certainly a reminder of that.
We are grateful to have you with us. Thank you very much, Jurrien Timmer, for being here today, and have a great week. We'll see you soon.
Thank you very much.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.